Retail inflation, those numbers are also expected in some time from now. The retail inflation print for the month of September is expected to be released shortly. India's consumer price inflation or retail inflation for September is expected to come down to nearly 5.4 to 5.5%. That is the expectation, owing to a sharp decline in select food items, including vegetable prices and edible oil. Now, September retail inflation print is going to be within RBI's tolerance range of 2 to 6%, and that is what many people are saying, many economists are predicting after 2 consecutive months. India's retail inflation, remember, in July was 7.44%. In August, it came down to 6.83%. Will it be within RBI's range? Will it not be there? Let's discuss that. Indranil Pan, who's the chief executive economist at Yes Bank, joining us on the show. Also, my colleague Krishnakumar here in the News 9 studio. Indranil, I want to come to you first. Good afternoon, sir. Thank you for taking time out. What are your predictions, estimations as far as the September inflation is concerned? Will it be 5.4? Will it be 5.5? What's the broad range you're expecting?
Our own expectation is 5.4. It's absolutely the median of the range that we are seeing. And obviously, the various factors that you just mentioned in terms of the vegetable prices, the oil prices, the fruits, all that has actually sort of likely to lend a positive hand to the inflation. Furthermore, this is the month also when we factor in the reduction in the LPG prices, which is expected to lower the headline inflation by around 20 to 23 basis points. So all taken together, we should be looking at a 5.38 to a 5.4% in terms of our own expectations.
All right. And, you know, a lot has changed in the last couple of days. There is a war raging in West Asia, which is going to play up big time in inflation, the numbers that will come out perhaps from the ongoing month. There is a possibility of a recession-like situation. Fuel prices are inching up every day, you know, $5 up, $5 down. There's a volatility that continues, that persists. What are you making of how inflation globally with emerging markets as well as developing markets will pan out in this month and months to come?
Well, I think it's a very important question, though a very uncertain answer. As the current sort of crisis situation emerges, it is unlikely that you will have a larger number of players joining into the crisis, and it might actually stay localized within the Israel and Palestinian conflict, and we are not expecting either an Iran or a Lebanon to join in. Now, if the Iran or the Lebanon joins in, and if there is a problem in the closure of the Straits of Hormuz through which the oil passes, and specifically to the Asian economies, that would be one of the bigger incidents that we can be looking at in terms of the negativities for the Asian economies per se. Having said, for India, we are holding the pump prices, and any increase in the prices of crude oil plus currency depreciation may not have a direct implication for the CPI inflation as we are holding pump prices, though it will have implications for a lot of other macro variables, including the fiscal and the balance of payments, but not on inflation per se, on a direct basis. However, on an indirect basis, because crude and crude derivatives are a significant portion of the WPI inflation, it needs to be seen whether some portions of that gets passed on to the end users, which will be an indirect implication in terms of the core inflation for the CPI.
All right. Yes,
if I were to add to that, we are also expecting the US CPI inflation data today. There is also the possibility that the inflation in US could be cooling from 3.7% to 3.6% on a year-on-year basis. At least that's what the street is expecting. Possibility of Fed rate cuts are being discussed. But at the same time, IMF has said that the only way the war could have an impact on global inflation is if it becomes a wider conflict that involves more countries. But if it's going to stay within Israel and Palestine, then there's a good chance that there will not be a wider impact on global inflation. Would you agree with that hypothesis?
Yeah, so I did mention the fact that at this point in time, we are working with a hypothesis that it does not escalate into many more countries joining into the conflict, and it remains an Israel Palestine conflict. And then we are in the safe zone of, say, an 80 to $85 a barrel in terms of the oil prices, having also factored in some amount of slowdown implications from China and also the US. You're right that the US inflation is likely to be cooling off, but let's note that any cooling off in the inflation in US may not necessarily mean that there's a rate cut story on, simply because I think we are far away from the 2% zone in terms of what the US Federal Reserve is mandated on the core PCE basis. And unless they confidently and on a durable basis are moving towards the 2%, I don't think a rate cut is on, which necessarily means from the Yes Bank perspective and from our desk perspective, we are not looking at any rate cut in the US in 2023.
And coming back to India, we know if crude prices continue to inch up, they could play a spoil sport big time as far as CPI inflation in the ongoing month is concerned. What sort of impact are you expecting? Let's assume crude will inch up to $100 barrel and above. Will that have an immediate impact on inflation, or do you think the government is going to absorb that impact as of now?
So, as I said, we are holding the pump prices, and to a certain extent, the additional taxes that we are collecting, the windfall taxes that we are collecting, could, to a certain extent, buffer the increased budgetary allocation that needs to be put out if we continue to hold the pump prices. Now, given an election year, I doubt whether the government would be willing to allow for an increase in the pump prices, which means that we would still continue to see relatively no direct impact of the higher crude prices globally onto the inflation in India. The only other implication is if the global risks were to turn out relatively more adverse.
Mm-hmm.
The question is whether we should be seeing relatively faster currency depreciation from an INR perspective, and that could add to the landed cost in terms of many other commodities, and that could have its implication for the headline CPI number rather than the crude in a direct way.
Hmm. And when you say a 5.4% target or 5.4% expectation for the month of September, what are you factoring in? Are you factoring in the reduction in LPG prices and the lowered food prices as well? And is that likely to continue into the month of August and thereafter? And also, if you could run us through what are your overall expectation for the quarter gone by is concerned. Is it 6.4 in line with the government, or is it 6.6? Because if you average it out and 5.4% is the target for the month of September, the average comes down to 6.6%.
Yeah, so we are also looking at a 6.6, which is equivalent to the RBI's estimate. There were fears that the 6.6 may not be tenable from an RBI's perspective, but given the slide in the inflation that we have seen, and especially helped by the LPG price reduction of the government, we should be attaining the 6.6 if our estimate of a 5.4 is correct. Yes, we have factored in the LPG price decline, which I did mention that was would be about a 20 to 23 basis points a downward implication for the headline CPI. We are factoring in vegetable prices drop, which has dropped again by almost a 20% in the month gone by, after a drop of close to 9.5% in the previous month. The only worry that we have at this point in time is the pulses prices, which is going up by 5% on a month-on-month basis for September. And given the lower acreage that we saw, a lower sowing that we saw in terms of the Kharif production, there could be some worries in terms of pulse prices going forward. Pulses also is significantly a Rabi crop, which necessarily means that given the lower reservoir levels, we could see some worry in terms of pulses, and that's something we need to factor in. Cereal prices is of course flat. It's about 1.1% month on month, both in August and in September. And immediately we don't have an implication of the El Nino, which has definitely led to higher cereal prices globally. But given the fiscal policies and the measures that the Indian government has taken
Okay.
in terms of in terms of stopping exports of certain commodities, we should be well buffered.
All right. And would you then agree with an overall FY24 target of 5.4%? Does that sound well? Is it within the limits that you're expecting?
So we in fact have a slightly a shade lower estimate at 5.3%. So 5.4% as an estimate is quite good.
Okay, 5.4%. It looks good. There is a lower estimate of 5.3% in Indranil is what he said. So perhaps inflation within the ranges that RBI is expecting. As far as, and before I let you go, I think it's also interesting to point out for the RBI to factor in the reduced inflation in the month of September and for the expectations for the month of October. What is your expectation on a possibility of a rate cut? Will the rate cut therefore be within this fiscal year itself? Or is the expectation now that RBI could be looking at a possible rate cut, not waiting for the next 2 or 3 consecutive quarters, but perhaps within this year?
A rate cut scenario is definitely not on for 2023 and for the rest of the financial year till March 2024. Very specifically, the RBI has tightened the liquidity, which necessarily means that there is no indication from the RBI that they would be softening their stance on the tighter monetary policy. So that's number one. Number two, the interest differential between India and US continues to be quite low.
Okay.
And that could be a little bit of a worry in terms of the future when we are also likely to see bond inclusion into the bond index. So all those factors taken into consideration, I think one, we are still not very confident about the 4% in this financial year as also for the next financial year. FY24 RBI's own estimate is on a structural basis that inflation should be around 4.5% or so, and hence the 4% continues to elude. So it's an evolving story, definitely not for FY24 financial year. Our own desk, we are estimating a Q2 FY25 to be the first chance for RBI to actually reduce interest rates, assuming that by that time there are clear indications of slowdown in the US, and hence the market starting to at least price in rate cuts by the US Fed.
All right, so Q2 FY25, that is the expectation as far as a rate cut is concerned. Indranil, thank you very much for joining us on this very crucial day. Remember, inflation numbers are expected to be out very, very soon. We'll bring them right here on News9.